Welcome to the All Financial Hour podcast with Steve All.
I think that's what a lot of people are concerned about when it comes to these Trump tax cuts. What the heck is going on? We're just going in circles. Eventually, someone's going to wave that checker flag, and we are coming up on the expiration of these end of next year. And if you want to take advantage of lower tax rates now, you can do a Roth conversion, and the money goes to as after tax. But tax guru, your buddy, Ed Slott, tells Morningstar that many are skeptical because they think that the government is actually going to try to tax Roths next. Listen to this.
I'm going to give you the secret that Congress doesn't want anybody to know. Don't worry about it. Congress loves Roth IRAs. I mean, loves, addicted, that kind of love. It brings in money. It helps pay for everything else. So luckily for us, they're so short-sighted. Remember, the only money that can get in a Roth is already taxed money. So they look at the Roth IRA as a revenue source. So I don't think they're going to kill their golden goose.
All right, interesting here. He talks about the golden goose and they're obsessed with it. And I'm just going to kind of give you the floor here, Steve. What do you think?
Roth conversions. I agree 100% with that. When they were talking about limiting Roth conversions, they were saying that if you have more than $400,000 in income, that you can't do Roth conversions. Well, that includes the conversion. But when they started to talk about that, they looked at it and said, but we're going to give you a 10-year leeway before that becomes into law or effect. And the reason why is exactly what Ed said. Congress sits here and says, if I'm willing to give $100,000 in taxable income, most of the people that can do that, it's not going to be at a low tax rate. We're going to give the government money early instead of waiting until they're 73 to 75 or until they die to get the money. So I believe that is 100% true. I can't imagine Congress getting rid of the Roth conversion just because of the fact it throws so much money into their laps. But I always get asked a lot of questions around how much do you convert? And then I say that's when I have to sit down and I have to do a full tax analysis. You just can't shirt sleeve that. And I have to ask questions. Are you charitable by nature? Do you give to charities? Why? Because once you hit 70 and a half, your charitable distributions should always go out of an IRA account. Why? Because you can give up to $100,000 out of an IRA account, and it count as a qualified charitable distribution if it's done properly. It has to go directly to the charity. You can't get it. It's non-taxable income to you. Mm-hmm. And if you're over 73 and a half, it counts towards your required minimum distribution. So that's what we have to look at this when we start to do with people. And we start to look at different things. There are different other things that we have to look at. How many kids do you have? If you got one child that's going to inherit it all, that could pass a tax time bomb onto them. If you've got 10 kids, not as big of a problem when it goes to those. So those are two of the things that we look at. And I like how Ed says it. He says if you got too much money in your IRAs and 401ks, you're going to subject yourself to tax rate risk in the future. You're going to pass a tax time bomb onto their kids. And I always get asked, what do you mean too much money? The average IRA has somewhere between about $150,000 to $190,000 in it. So if you have an extra large IRA account between $250,000 and $750,000, chances are you might spend down those assets during your lifetime. Depends on your incomes and on what your lifestyle is. If you've got a double X between $750,000 and $1.5 million, you're probably going to pass on a tax time bomb to your kids because most of us believe that taxes are going to be a bit more in the future. And if you've got a triple X, 1.5 or more, you will probably pass on a tax time bomb to your kids. What do I mean to that? Well, everybody believes that rates are going to be higher. Well, if your kids get it at their higher earning years and you pass away and they got 10 years to deplete it, do you think they're actually going to pay less taxes than you did? I believe that eliminating or lowering your taxes in retirement is the best thing you can do for successful retirement. If you're in that area where you might be passing that tax time bomb to your kids, give me a call now. Ask for that tax analysis. Let's look and see how it might make sense for you to go ahead and pay some taxes now at a rate you're agreeing to pay with versus what the 535 people in Congress think you might need to pay in the future.
Steve, why is trying to time the market a bad idea? Well, apparently there's a new report that asked this question. It basically found that going in and out with investments might avoid some down days, but you could also miss out on the best ones. So what are the facts about market timing?
Market timing, basically, in my opinion, just really doesn't work. It's usually based on emotions. And when you start to go into the emotional side of investment, that's, I think, where most people get hurt, where everything's going well. I don't need an investment advisor. When the markets are high, when you might make time to sell, then the markets start down. And when those markets start down, it's like, oh, I should have quit a long time ago. And they go back and they just, emotions are the worst thing that you can actually do when it comes to investing. Mark and Debbie came into the office, and they got some money sitting on the sidelines. And they said, we're not sure. Steve, when do you think it would be a good time to buy? And how do you look at investments? So I look at it to the part where I think your investment should be based on need, not greed. Because I think that's where a lot of people get in trouble. Give me the best return that I can possibly get with the least amount of risk possible. And I want to protect the assets. So we go from there. So I know a lot of you people out there are in that same category, that you're not sure. The three major questions. What are they? When do I hold? When do I sell? And when do I return to the market if we made the decision to move out of it? And that's what I love about Brad Jenkins in Market Guard. Brad's mathematical, methodical, non-emotional models can assist us with those areas where we can look at it. If you're that type of a person that is concerned and you're willing to move, you want to move in and out of the market when the models say to do it, not when the emotions say to do it. That's what we have. We have that availability. It's called our target models, and we can be aggressive, target 100s. We can be conservative, targets 30s and 40s to meet whatever you're at. And then we also have in the investment, we have stock portfolios where we can be as aggressive as you want to be. If you want that dividend-paying portfolio, we can work on those also. So that's what I believe is having a good mixture when it comes to the investment world. That is what? As I said it again, I want to repeat it. It's a proprietary method. It's based on non-emotional, mathematical, methodical approach on how to invest. And the big question that it asks is, when do you hold? When do you sell? When do you return back to the market? So if you're concerned about the market volatility that's going on there, ask for that risk-reward analysis and how we can protect your assets with or without an annuity. Give us a call now. Ask for that risk-reward analysis.
There's been lots of speculation about Social Security for quite some time now, Steve. I ran across an article that says that more problems are to come, that if nothing is done, benefits will be cut back by 25% in the year of 2035. Of course, nobody wants to tackle that right now. The article contends that waiting until 2035 is the same as basically trying to change the course of the Titanic after it already hit the iceberg. Basically, you're just late to the game. So it would be too late. So if Social Security goes away completely, or maybe it's diminished a little bit, can we take steps now to kind of safeguard against that?
There are methods. I got to look back. In the 80s, I didn't think Social Security was going to be here. When the first guy I met in the financial planning world said, well, what do you going to think your Social Security benefits are going to be? I said, do you actually think Social Security might be there when I turn 62? I didn't even think it was going to be here because it was ready to collapse then. That's when in the early 80s, they went ahead and started taxing the benefits because prior to that, Social Security benefits were not taxed for federal purposes. And then again in the 90s when we thought Social Security was going to go away, they again upped the number. Up to 85% of your Social Security could be taxed. So Congress will probably kick this can down the road as far as they possibly could. Some of the things that they're currently talking about, raise the contribution limits, take the caps off. Whatever you make, you pay into the Social Security. The problem with that is they are going to have to give those people back some of the money that they had withheld. They're talking about possibly limiting or maximizing the spousal benefit. One of the things that I believe, this is my Steve All's opinion, I think they'll means test Social Security. There are people out there that could survive if they didn't have their Social Security check. Now, before you call me up and say that's not fair, I will agree with you. They paid into it. They deserve it. But we start to look at it when the average Social Security check is somewhere around $1,100 to $1,400. If they had a 25% reduction in their benefit, could you imagine trying to live on $1,000 a month? When there are people out there, and I'm talking about people that got $40 million or more. Do you think Warren Buffett could survive if he didn't get his Social Security check?
I think he'll be okay, yeah.
Do you think he'll be okay? What about Elon Musk?
I think he's going to be okay.
Jeff Bezos would probably be okay. Those guys are probably going to be okay. And I think they would rather have those cuts than to somebody that's getting $1,100 to $1,200. Because if average is $1,200, that means there's people out there getting $500 and $600 a month. They just can't afford a 20 to 25% cut. And if we look back 5 to 6 years, 7 years ago, Medicare was the same price for everybody. Mm-hmm. Now Medicare is also means test. So I do think that's going to happen. But there are things out there that the insurance industry is looking at it. I mean, I'm a full service person. I do assets under management, investments, stock portfolios, ETF portfolios, all that good stuff. I also do life insurance if we're looking for legacy planning. And I do annuities if we're looking at income. But there are annuities out there right now that they've already looked at it to the fact that what's going to happen if Congress changes or reduces the amount of Social Security. So what they have is they have annuities within what they call enhanced benefits, that if Congress makes that decision and does reduce the amount that you're going to get for your Social Security check, that you can take this enhanced value and get it paid out over a certain period of time. Not just a single lump sum, but to help offset if they change the amount that you're going to get in Social Security. So the insurance industry is already looking at possible solutions for this problem. So if you're concerned that a reduction in your Social Security check will affect your retirement, call now. Ask for that Social Security optimization and how an enhanced benefit program might work for you. I will tell you, to do the Social Security optimization, we have to do a full review. I can't tell you you can delay your Social Security without looking at everything you have. So if you're in that category, call now. Ask for that Social Security optimization.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.